Well, it's great to be here with Alex Konoplasty of Flashpoint. I'm Haim, Global Vice Chair of Latham Watkins, a leading law firm's growth practice focusing on technology and life science transactions. Alex, great to be here with you.
Yes, Haim, thanks a lot. It's likewise a great pleasure. We've known each other for a long time, so it's not only good to be friends for so long, but also to partner with Latham on a number of things for Flashpoint is super important, and it's really a strategic relationship for us. So thanks for having this conversation.
Absolutely. If you would have told me that 25 years ago when we were drinking, that we would be here talking about our strategic professional relationship, I would have probably drank more. So it's great to be here and see you over many continents. So it's terrific. I think we're going to cover very broadly growth, private capital, growth, venture capital investing. And with that in mind, before we jump in, maybe you can tell something about Flashpoint and what your focus is before I start lodging in my 20 questions, or many less, I promise.
Sure. No, absolutely. So yeah, Flashpoint, we started in 2013, investing our own money, coming from private equity investment banking backgrounds. Our expertise before that was around tech, telecom, and media. So basically, with Flashpoint, we are basically following our DNA and following our expertise in that sense. Our focus is we're based across New York, London, and Tel Aviv as our main axis of operation, and we're supporting companies that are originating from sort of emerging Europe today. Central and Eastern European countries, but also Israel, moving basically west. So that's where we specialize in. We ourselves come from these backgrounds and essentially helping companies grow their personnel, build organizations, raise capital, and exit in the U.S. That's our main areas of focus.
Excellent. And as you know, I share that background, even though I've been in the United States now since I was 10, and I'm very thoroughly American, but share the same former Soviet and Israel background with you guys. So glad to see that. I'll launch right in there. And how would you describe the current global private capital environment in growth tech?
Yeah, I think it's been quite bumpy last sort of 5 years after the long bull cycle we've seen post the basically '08 crisis. Lots of liquidity, lots of tech evolution and development. I think people got a little bit too relaxed. Everybody was thinking about growth and pushing the boundaries. I think with the macro changes, both economic but also with the geopolitical changes, we feel like the environment has been evolving quite dramatically. And now I think people, in general, the markets are more focused around sort of quality versus growth on one side. On the other side, I think capital has been a lot more selective in terms of verticals with AI evolution, with things that new technologies are bringing to the table. I think things have started dramatically changing in the last 3-4 years, to be honest, which is probably one of the fastest technological developments we've seen in the last couple of decades.
I mean, so I know we're supposed to take turns on the questions here, but since you raised it, what are the specific regions and subsectors? You mentioned verticals that are a huge focus for, you think, globally. And please don't give me a cop-out with AI, because we can talk about that later, but that can't be the answer to everything. And then for Flashpoint, are there any specific type of companies, founders, backgrounds, and verticals in the former Soviet Union, Eastern Europe, and Israel that you guys are following into the West?
Yes, I think for us, one of the areas where we're quite excited about is supporting this trend of countries that have been less developed, where you see lots of tech talent that is underpaid, people who are hungry and pushing for more motivation and more success. And I think also smaller markets. And I think it goes in the same way for Eastern European or former Soviet Union countries where the markets are domestically very small, but also for Israel, which does not have a big domestic market. So we've been quite excited to follow these companies and support these founders. And broader Europe, I think, in general, has seen less sort of capital and less venture investments in the last years. So founders are looking for capital, and most of capital today comes from the U.S. market. So I think this trend has been developing on one side. On the other side, we've seen the war in Ukraine basically pushing people out of their home country. We've seen war in Israel also impacting lives of people and how people amount of capital in Israel has gone down by like 4 or 5 times. But on the other side, Tel Aviv Stock Exchange index is like all-time high. So I think that there is this decoupling between like public markets, private markets. People are more cautious. Obviously, nobody wants to invest in Ukraine today for obvious reasons, but there are great founders, great technologies coming out. So I think there is this trend, geopolitics versus macro, and more shift towards US, because we don't see founders going to China. They more from cultural and other areas, it's easier for them to scale in the US economy on one side. From the sector perspective, I think there's been also a bit of change from high trends in like software as a service. We had climate tech coming up as like a big theme. Now it's changing a lot in terms of like defense tech becomes one of the like topics which never existed in Europe. In particular, there are a bunch of funds that are launching there. I think AI is changing from the way we see things, is that obviously we are in a way a boutique asset manager, manage about $650 million assets under management. So we don't have so much capital, and our funds are smaller to push for infrastructure in AI or like LLM models, stuff like that. We just don't have so much capital to compete, and obviously there are big players coming into this market. We've seen this recent deal with NVIDIA, OpenAI, just $100 billion investments.
It's not small.
Yeah, it's not small by any means. I think the way we are focusing, where we see opportunity, is around basically proprietary data in big verticals. So take banking, healthcare, insurance, big real, asset classes where there's lots of proprietary data, which will never probably end up in OpenAI or Google models or any other models that are basically not owned by these corporations. So corporations are very cautious about it, keeping their proprietary data, and that's where we feel like a lot of innovation will happen, because they do want to develop, innovate. It will be hard to kill them entirely with new tech, and AI is not a recipe for like everything. So.
And is that where Flashpoint is focusing, allocating its capital specifically?
That's where we've been spending the last like 3-4 years. The last like 10-15 deals have been around these areas, around big verticals, as I mentioned. On one side, on the other side, I think the second thing everybody asks us, okay, so software is dead, AI, Vive AI. I think
nothing is dead. Nothing is ever dead in today's cycle. There's always resuscitation.
Well, that's true. But the interesting thing about this is that we've been always focusing on business sort of problems inside big corporations. So we're a B2B software focused investor, and I think where proprietary data meets specific business problems that require still like a screwdriver and somebody coming in and figuring out how the process works. How are you SOC compliant, or how do you meet regulatory standards? How do you meet, and maybe that's also a question for you, how does this regulation impact, CFIUS in the US and also like in European regulatory levels? What are you seeing on your side? But we think that this gives an opportunity, actually.
Yeah, no, absolutely. And I'll jump in on that question just quickly, because, I don't want to bog down into the legal morass of it all, but it impacts everything, in terms of CFIUS investment structure, particularly the focus with U.S. legislation, including with the AI. The focus has been with China. And we have seen an almost complete trickle down, a decoupling, particularly in terms of investment into China. There's almost none that we are aware of and working on from U.S.-based entities and entities other than direct trade. And then in Europe, it's a more mixed bag. There, it's lascivious, obviously concerns, but it's more concerns about privacy and the layers on it. I think there's right now a deep competition to make sure, since a lot of these entities and investments are AI related, that they won't get in the way, that the regulatory layer will not get in the way of the business strategy and actually being able to execute. I will say, and putting aside my American bias, because Latham obviously has offices everywhere. We love our colleagues in London and Germany and in France and Italy and throughout Europe. But the U.S. regulatory regime has been more open to moving fast and being a very flat single regime for investments. And I think that is perpetuating the advantage that you were talking about already, where there's just larger pools of capital in the United States. It's an area where the capital markets have been robust for a very long time, where many of the larger companies are based anyways in terms of decacorns and, the trillion-dollar companies. They're basically, outside of two or three in Asia, they're all in the United States, and they are obviously driving a lot of the investment that we're seeing in the market. The U.S. regulatory regime is a little bit easier to handle. And so what that means is we have seen more of what you're saying is companies, particularly larger ones, setting up here and investing directly in the United States, further perpetuating the growth in the market.
Do you think, just another question out of curiosity, so, we are focused more on, B2B software historically. I know you were personally doing a lot in like bio, life science, etc. That's where you guys are spending quite a bit of time. In terms of this regulation, how do you see it, across the sector? Because we're thinking about also maybe exploring some strategies around, life and bio technologies. What has been like the developments in the last 3, 4, 5 years?
Sure.
So this AI regulation, is it this or approach, the stance that the government takes, is it similar to what happens on the other, in other sectors like life and bio, or is it different?
Yeah, there's other regulatory regimes that impact life sciences and biotech in particular. My practice at Latham obviously does tech, lots of tech, including representing some of the biggest AI companies, including the ones you may have mentioned earlier, as well as smaller startups and all their investors, and also life sciences. My practice personally is pretty split between technology and life sciences. The regulatory regime on the CFIUS obviously impacts any investment. There's traditionally been less investment in life sciences outside and into Asia in particular for life sciences. So that's had less of an impact, but what has had a great impact is the deep changes in the FDA that the Trump administration has brought forward, and then the potential legislation that's been discussed in terms of drug pricing and where drugs can be sold. What we've seen in terms of trends has less to do with legal than to do with the attractiveness of royalty and royalty monetization. Asset-based financing has been very popular throughout. I think we're going to see it more, from the GPU financing that's taken over the world, including some of the dollar sizes that are just dwarf imagination. But in life sciences, the royalty and royalty-like, actually getting the royalty stream, the revenue stream from the royalty, separating it from the company, financing that. And we've been very active in doing lots of transactions. The public ones I can mention that are out there include with Bridge Bio, a very large synthetic royalty with debt facility. I think one of the largest ones of the year. The largest one with Revolution Medicines with Royalty Pharma of up to $2 billion. We did another Royalty Pharma deal with Biogen for a separate asset, and then there's been another one with Eagle Pharma with a separate SPV moving the royalty and SPV. So there's lots of structures. I think we've been very fortunate on my team to work on over 60% of the deals that have cleared the market, but the royalty-like structures, even in deals that haven't cleared, have been discussed throughout. And I think in a world where capital is so needed and is available, but will likely flow into the larger dollar assets. So all the GPU, all the AI, all the data center, I think they're going to continue to attract the billions of dollars. I think for every company, it's incredibly important once they reach a certain level, say a Series C, to start thinking on asset-based and royalty transactions and how they can be best positioned to do that. We also think it's very important for investors like Flashpoint to keep that in mind, because those facilities tend to be less dilutive. Sometimes they'll have a warrant, sometimes they'll have a trigger, but they're not straight equity. So it's something that's very attractive for venture capitalists or growth investors that are already in the company to layer in that type of royalty facility. Obviously, everything comes with a risk. But you know, like they say, like Elon Musk says, he eats risk for breakfast. So, yeah,
with eggs and bacon.
Yeah,
it's interesting because we actually started. The vision that Flashpoint has is to build a platform. So we see for ourselves two clients. One client is the founder, the other client is the investor. And I think the way we think about our mission is to basically cater to the needs of these founders. So the equity product that we discussed a little bit that we have, and we started investing, we're in Fund 4 for that product. But we also started doing other products, essentially to try and get away from the fear of missing out and building the relationship with the founders. So that's our long-term vision. 5 years ago, we started lending from zero. We've never done any debt. So it's interesting you mentioned these things about asset-backed financing, et cetera, because that's what we started feeling a lot around 2021, that basically the equity risk and the way companies perceive the cost of capital has reversed.
Yeah.
We saw a lot of founders tell us, listen, equity is cheaper than debt, which is contrary to what we studied at school.
I've never, that doesn't work mathematically very well.
But, so we started lending, and now we're investing out of Fund 2. And I think what we've seen more from like the crossover, cross-Atlantic sort of trend, which I find interesting, is that, especially on the back of high interest rates, is that, after Silicon Valley, Bank unfortunately went down. And
it's been so long ago. I'm trying to forget it. It's been March 2023. Is that?
Yeah, it was actually quite. It's been so long in terms of industry development, but it's just been quite recent. But then in Europe also there are a couple of lenders who got acquired, and then Europe is like a lot more conservative market. So what we're seeing, actually, interestingly enough, is that we see a similar trend for sort of in the debt segment that companies are looking for debt financing. And also with the macro changes and market changes, we find this quite interesting. And I think with development of AI and the things you mentioned, GPU financing, infrastructure coming into play, robos coming into play, I think the whole like tech scene, going back to our discussion about like how the growth will be changing, I think this whole thing is like really changing from software to like other types of technology quite fast. So quite interesting to observe.
Yeah,
this
absolutely. And where do you, I mean, in terms of Flashpoint and the different products it has, where do you see the focus? How do you combine them together? What's the future look like on that? Is it a multi-pronged asset manager?
Yeah, from the founder perspective, the way I see it is that ideally you want to try to make like 3 times money to your investors, and then you can come and work with the company at different stages of its development.
Everybody hear that? Just 3 times. You don't have to do more. He's not that greedy.
No, I think it's very hard to make consistently, with a standard deviation, plus or minus 3 times. I think it's quite challenging to keep it consistent. So, our approach is to basically try and focus on the relationship with the founder over time, and basically try to give him money or her at the times when basically it makes sense and where the risk versus return for us as an investor makes sense. But then also it relates to the investors that we are seeing, for example, because we're working with, so our other client base, because people, I think, like in the current cycle, people want more liquidity versus like 2021, 2020, 2019, where everybody cared about growth, right? Nobody cared about anything, sort of holding periods, liquidity. Now, people don't want long holding periods. They want more liquidity. They want shorter duration. And obviously, this early equity product that we have is not, as sort of topical. People want more buyouts. People want maybe a combination with liquidity. So that's also what we're thinking about, to how do you cater to the needs of our investors, and how do you grow the liability side of our business, maybe somehow, being smart about these products. So that's one of the areas for our development as well.
And are you seeing the market push you guys to focus on one versus the other, or are there opportunities for all fairly equally?
Yeah, I think we're seeing about 7,000 companies per year. So it's a big funnel, and that has grown in the last 10 years, obviously going from like close to like from hundreds to thousands. Obviously there are like bigger players than us that are seeing like, hundreds of thousands of companies per year. I think what is happening, the way I see this whole technology space developing, is that with companies becoming more online and leaving more online traces, with AI coming into play from your analysis, sourcing, back office perspective, I think we're going to see a lot of convergence between public and private investing. So at some point, like 5-7 years ago, our main sourcing, you mentioned sourcing, so our main sourcing was like conferences or local presence. Everybody cared. If you talk to investors, they will be questioning me, Alex, like how proprietary is your deal flow?
Yeah.
I think, with the AI and technology innovation, this is all changing, because I think in 5, 7, 10 years from now, everybody's going to see everything, right? And the amount of data you will see about companies, you can track all the LinkedIn, all the Meta publications, all Twitter publications by the CEOs of these startups. You can gather lots of data points about what their employees are leaving, and then you can combine all of this, and then you can find signals, understanding how big is the company, how much revenue does it have, you never met the founder, you never spoke about the company. It's all like agents.
It seems crazy. It seems crazy though, because that would lead to whoever's got the largest agent with the largest pool of capital is ultimately going to dominate this in a singular way, right?
I think size will be. It's like in your practice, like bigger firms eventually consolidate because clients look for quality. Yeah. Quality comes with a level of professionalism, discipline, processes, etc.
Depth of practices, ability to cover
access to capital. So in our industry, access to capital is important. So I think what we've seen in the 2020 cycle is that top 5, 10 U.S. firms were raising 80% of all capital, right? Yeah. So I think that's what's going to happen. Like in this next up cycle, is that people who have more access to capital, people who have better technology, they're just going to drive the market. And then the rest of the smaller guys, you're going to get the crumbs, bits in here, bits there. But eventually, I think it's a game of scale. I think that our industry is like moving in the direction. So for us, I think it's also the game of scale, and that's why we want to have more products, because it's a long cycle. If you think about the private equity investing, it's like 6 to 8 year cycle, right? And you can't make miracles. If you make 3 times, it's a good return. But shorten the cycle, you can't shorten the cycle. It's impossible. And then scaling just one product, to get to size, it took some people like decades. If you think about the big boys, it took them like
it did long time.
Long time.
Yeah. People forget about that. What in terms of seed investing, which on the equity side is a focus for Flashpoint, what are you going to be looking for in this world where scale is going to matter more than ever at the company level? Like, are you going to be looking for I'm going to invest in this company because it looks like it will hit this milestone that will make it scalable? Is it change your investment thesis based on this world that you're talking about where scale really matters?
Yeah, I think the way we think about it is that essentially we don't do as much seed, so we come into companies that already have data. So for us, the data signals the quality of the product, the usage statistics, who's using the product, the level and the depth of integration. So how deep this AI application goes into the corporate, how many integrations, how much basically security, how much compliance have they invested in to build the moats. So this becomes important to differentiate from other big AI platforms. I think for us that is super important. Size of the market matters, technological moats matter, scalability of the business model. I think the business models where from the 20th cycle where you just invest heavily into sales don't work as well. So we see more companies with product-led growth, companies that are becoming a lot more efficient, because the next stage investor, they will come and they will be looking at your essentially efficiency metrics, and people want to see profitability much faster now. And it's interesting because now with the check size that some of the corporates are prepared to pay for AI-enabled products, the check size, the annual customer value is quite large, and which allows smaller teams to build products that have millions of dollars of revenue. We have a number of startups that launched, let's say, 3-4 years ago, team of 10 to 20 people generating $3-4 million of revenue, profitable, right? We haven't seen anything like this like 10 years ago. Now it's a big trend that we're seeing. So
interesting. So it's actually a faster cycle. Where I know that Flashpoint has an office here in New York, and that you are obviously here. We're here in New York City talking. What is your view on the U.S. market, New York specifically, U.S. market more generally in terms of global technology investment?
Yeah, I think New York for us is great. We like it here a lot. It's a very dynamic city. I think a lot of companies that come cross Atlantic, they land in New York. They don't go to the Valley because of the time zones, and also it's important to keep in touch with your developers team in Eastern Europe or Israel. So Silicon Valley, it's like you're completely cut off, and also it's harder to travel because you still need to be closer to your team. So in that sense, East Coast in general makes sense. And in the last decade, we've seen New York really rising. New York, Boston, I think it's been like becoming a real big hub that is competitive enough with the Valley. So from that sense, that is important. I think U.S. in general, because it's a homogeneous market versus Europe, which over this decade, despite the EU, has been becoming a lot more segregated, both from regulation perspective, political changes that are happening. I think that's been impacting scalability of companies across Europe. If you look at the fintech space, how the banking regulation has played out, now we look at the digital assets, it's like, it's a myriad of regulation there. It's very hard to operate if you're, trying to build something big. In that sense, US presents a, more or less homogeneous market with a single language where it's much easier to scale. And then access to capital, as we discussed before, size, liquidity is important. For us as an earlier stage investor, what matters is how much liquidity do we see in the next stages, and also the exit potential. I think that's where US, fortunately, unfortunately, being more European, I think it's a bit unfortunate.
No bias. We're putting aside our biases. When we drink, it doesn't matter.
Exactly.
Just remember that. So what are you telling all your companies? So you have a Israeli or a Polish or an Estonian or a Finnish entrepreneur, founder, startup. They're starting a company. You like it. Obviously, what is the first thing you tell them about their footprint, where to set up, like what to do? What's the game plan that you kind of lay out for them?
Yeah, I think what is becoming more important for companies is to have very clean governance and set up day one in terms of the investment that we make. Obviously, with a safe instrument that has in a way played out in the last decade, which was non-existent before. Yeah. So now the whole investment vehicle, investment terms have been streamlining a lot. The term sheets that we offered 10 years ago are now one-page term sheets. Yep. So I think thinking about it day one, early on, is important, not to create complexity within the vehicle structure, creating governance and board structures and board processes that are scalable. So that's one thing. That's where we come in as a more institutionalized investor. Number one. Number two, in terms of going to the US, I think obviously US is expensive, right? So I think hiring people here is expensive. You have, higher taxation. In Europe, you can get some maybe subsidies. And
Even relative to Europe, it's still more expensive.
of course, I mean, if you look at like renting office, hiring people, finding a great salesperson or a good marketing person, it costs it costs a lot.
Yeah.
So for companies who are scaling to the US, I think the amount of capital they raise becomes like a challenge. So for us, it's important to calculate the budgets properly for the next 18 months or so to make sure that the company is well funded. It's not going to run out of capital, and we can afford to play some scenarios and play some sensitivities in case we don't get it right straight away. So these things are important. Of course, early stage investing implies risk and mistakes. You can't always be right, and that's why for us also it's becoming more important to be like cautious and on one hand, but then be more sort of careful in terms of assessing the risks of the companies. I think with less liquidity available, I think that that is really one of the.
Do you tell most of your companies to start that, hey, you need to do XYZ in the United States. You need to make sure that you have a footprint. You need to do a Delaware Corp or a Nevada Corp or Texas Corp, whatever the popular one now. We're agnostic, by the way, at Latham. We support all our clients. The crazy debate between Delaware and non-Delaware is hopefully calmed down. But do you give them a strategy? Do you talk about it? Because obviously you have an office here. The market is very robust. Everything kind of seems to be leaning towards sales. It's where most of the more successful companies IPO, although London is still a very important player. How do you set them up for success and optionality?
Yeah, I think there are a number of considerations here. Where do you set up your holdco? So Delaware is important also for the shareholders agreement and how you structure the rights, et cetera. Number one. Number two, ESOP structuring. Where do you have your ESOP? Think about your taxation. Where are you coming from? If you're from Israel going into US, how do you structure ESOP day one is important in the end, because we don't want to see lots of leakage out of that. Intellectual property registration. We do have companies that might have a holdco in the US and then a company in Poland, right? So where's your IP? Do you keep IP in Poland? Do you move IP in Delaware? What is the transfer pricing risk versus the local tax authorities who might come after you, especially as we discussed the currently more challenging and changing political environment. We see governments, enforcing a lot more.
It's not challenging. It's not hard. Yeah, no, it's one of the most challenging political environments out there for sure.
Yeah, so I think these considerations are important, like at the setup, because sometimes people just get it wrong, and then it's harder to like track backwards, and also it's becoming more costly.
Yeah, I mean that's a very important point, and that's something, by the way, that on the legal side we focus on it, because where we obviously do early stage, but we represent companies, as we say, from 0 to 60 miles per hour, or 0 to 100 kilometers an hour. I know you drive fast, so maybe it's 0 to 120 kilometers an hour.
Germany, there's no speed limit.
There's no speed limit. We're not in Germany, but so we see companies through the ecosystem, and one of the things we tell them is, look, you could save some coins early and not do this, but the changes, particularly in the transfer pricing and taxation, if you have to flip later, if you haven't thought through a step, if you don't set up the ESOP correctly, can be very dramatic and costly. And therefore it's worth thinking ahead on doing that, particularly with the US market being so clearly a destination both for investment, capital markets, and most importantly, end user. I mean, at the end of the day, revenue is the king. So do you get resistance from companies because of the upfront costs of setting up in the US?
Oh, that's actually one of the things I was wondering to ask you about as well, in a way that what we're seeing is that we've seen like US being like a more liberal, more versus Europe being more conservative, US being more founder friendly in some ways. But one of the things we are observing, for example, for companies that might not be like outperforming, we're seeing like a number of structured deals, and that's where I was wondering what's your take, and how do you see environment right now? Like, are people going more into structures right now because they're more cautious? What are you seeing?
Yeah, so great question. So in terms of the structured debt and equity that we're seeing both on the private capital side. a few different stories. One is if you're early stage, our general view is if you're too early, say before Series C, you got to keep it simple. So at that point, you either can get the debt facility that you can get, and it's usually small, or you take the equity, even if expensive, keeping it simple with less covenants, more NVCA style form that keeps it simple because you'll complicate your life, and then you just need to perform. Later stage is a very different story. Later stage, there's two multiple stories. One, there is the great performing company that is near an exit event, be IPO, M&A, whatever, and wants to bring in more capital to solidify the balance sheet, make sure they're well positioned. They can do all sorts of structured facilities from pre-IPO converts, etc. And they're usually very sensitive to having a priced round. So they don't want to have a valuation at that point because they want to wait for the market to do it. We're seeing all sorts of facilities, and we have worked on some of the leading ones, including a relatively new structure. It's not that new anymore, where you do a pre-IPO convert that continues as a publicly traded convert, DTC eligible after the public. We worked on that facility in Netscope, which just IPO'd for Morgan Stanley Tactical Value. There's ones before with Arctic Wolf. We work with Blue Owl on that one. And then there's another one, and we did the first international one with PayClip, one of the leading fintechs in Mexico, where you set up a pre-IPO convert. You don't get a price right now. There's a discount, but you can also float into a public convert if the dynamics are correct. Those are highly structured, very complicated. But if that's what you're trying to maximize and to get the investment value you can, there's a lot of more simpler, more plain vanilla structures where you can provide the equity investor, the growth investor, some protections, some downside risk protection for what is generally a lower cost of capital than a straight priced equity round. And that market was very attractive and very popular, and it's still there, but it's not as much there for the crazy high flying unicorns, because for them it's very easy to access raise capital and raise the public markets, and they're okay with the marks because the marks are usually very good.
What do you think about this recent deals that have been direct IPO, to individuals? Is it a trend?
The direct listings? Direct listings were very popular more in the 2020. We, again, one of my partners, I'll give him a shout out, Greg Rogers, invented the direct listing platform, and we did it on the Spotify deal, which was the first direct listing at the time. So shout out to Greg Rogers and our Latham Watkins team. We've done multiple ones since then. I think we have a dominant market share. We have not seen that be as popular recently. There's multiple reasons for that. One of them is there's just so much money available in the private capital market, so you can raise that kind of money there. And then the secondary sizes for secondaries has been extremely attractive, so folks would rather do that and then wait for a more conventional IPO if they're waiting for that moment rather than do a direct listing. We have been in discussions with numerous companies on them, but they have been less of a popular menu item for a while. But where our view is, there's no such thing as taking off menu items because you're concerned about it. There's a risk and reward with every type of structure, and a great one is the SPACs, right? There was a period where SPACs were very attractive. Obviously, those companies haven't performed relatively as well. We're seeing a resurgence, some SPACs coming back into the market. Some of those companies are because it's a great menu item for certain companies to access retail investors in a way that they wouldn't be able to access without using the de-SPAC route. As long as the risks are there, we're seeing a much more robust SPAC market coming back now, because if you're a certain company that has very solid projections, yet less revenue now, and want to press into the public markets with those projections, a SPAC structure can be very attractive if you have somebody who's committed particularly on buying the convert on the SPACs.
Interesting. Yeah, because one of the things that is curious in terms of this structuring and eventually exit is that as you see fintechs developing, you have more technology, private individuals are becoming a lot more sophisticated because the tools that they're getting, the amount of information that is out there, allowing people to analyze. We ourselves, we are using obviously, AI bots to, already today you can replace like 60-70% of like analyst work just with pure.
Don't say that out loud. You're gonna have a lot of people sweating once we're listening to this.
No, but I think it's an interesting development, like whether directs will be like gaining momentum, because essentially all of the value chain between the retail investor and then the company that is actually going public, because it's the retail investor's money that is managed then by a chain of other people, whether you can like actually
shrink it. I mean it's a great question. So our experience so far has been, and we'll see how it changes because it's rapidly, is that all AI has just sped everything up. So the ChatGPT it's a tool for associates and a tool for the analysts to just do their job faster. But we haven't seen less of a demand for the human services yet, as we have seen more demand for more deal, more work. So before, if we were doing 2 transactions in a week, now we're doing 3, and so on and so forth, because the demand has come. Now, whether or not that lasts or whether or not that's eroded down the line, we'll see, particularly on the services businesses. But we haven't seen, that layer take out. So I'm assuming it's the same thing on the fundraising environment, where it just makes things faster, more efficient. But it's like software was, 20 years ago, and it's like the mainframe computer was in the 70s or 80s. It doesn't eliminate the need for labor. And in fact, there's many theses that it may actually increase in the near term the need for certain labor. Not in all industries. Some industries will be more commoditized, we think, and there'll be, but I think there is a very strong thesis that it will speed up transactions that would have taken much longer, therefore meaning that you still need the labor and the services to do those transactions, but instead of doing 3 transactions, you'll be doing 6. And now it'll get it done much faster and more efficiently. That's at least what we're hoping for. That's what I'm telling all my associates and junior partners, usually with some whiskey. That it's less of a fear. I'm more of a techno optimist on that front.
That's a very positive note, Haim.
Yeah, very positive note. Do you guys take a different view, or?
I think that basically, a lot of, for us, where we spend a lot of time is, analyzing markets, analyzing company data, because obviously a lot of the work that we're doing is trying to, forecast and predict how this particular business model will work in a particular segment, times the scalability of sales and marketing, right? Because then we need to get the economics right. So I think that a lot of this work will be basically done by, essentially AI, which is, capable to speed up analysis. That's where, I think we might be sort of finding some roadblocks and taking time to make a decision. So I think the decision making will be much faster, to a degree, to what you said, so you can be processing more deals essentially, but then also spend more time on like quality assessment, quality thinking. I think that's definitely changing for sure.
Interesting. And in terms of, is there any way that you think, in terms of an investment perspective, to get ahead of these trends, or is it they're just going to amplify whatever thesis you already have? Has it changed your thesis of investing versus amplified it? These are the industries that are going to be the most, it's going to really speed up uptake of these industries, versus these industries are gone?
Yeah, I think that some industries are definitely gone. For example, HR tech, or the way education is going to work out in the end, the way that a number of sectors, marketing technologies, but a lot of these things have been evolving as well. So if you look at like marketing tech 15 years ago, it was a totally different, tech stack, or the way what was possible in terms of education. Right now with like Duolingo, which obviously started a long time ago, but it was not as efficient and possible to study anything. Now it's really changing. So I think on one side, we will see like evolution of the prioritization of industries on one side, but then there will be also new industries appearing, because, as we with like, mobile totally changing the way we operate, or the tools we have with iPhone appearing just 18 years ago, the world has changed, right? The way commerce is playing out now, etc. So I feel like these developments will be creating new industries, and potentially in certain sectors that are not as in a way that are technological but not as fast paced. For example, cars, right? There's been a lot of evolution, obviously, in heading towards electric vehicles, but on the other side, the cost of batteries, the efficiency is still prohibitive. It's not like, it's very hard to push the boundaries and push out like other manufacturers. So I think like these, or robots, right? It's not as vastly used in our day-to-day environment. I think these areas with AI, the compute speed.
How do you know that I'm not a robot right now?
Exactly. No, it's. I think that a lot of these industries will change. Some will disappear, new ones will appear, and I think that's what makes our job exciting. Because 13 years ago we started more with consumer, to be honest. Then we focused more on like e-commerce tech, sales tech, marketing tech, efficiency tech. Then we moved more to like B2B software as a service. Now, for the past 3-4 years, we're doing mostly AI applications. 5 years from now, we might like be more focused on like as robo production, for example, becomes more massive, and that would create like totally different opportunities in terms of what tech can do.
So I always have this question. So as you know, I'm not a good player, but I love to play poker. I'm actually pretty decent, but don't tell my wife I said that. If you think of the investing world as a poker table, and you come in there and you have options on what to change, right? In terms of the global world of investing, what would you change? Would you change the house, how the money is allocated, how it's like your ability to control the regulatory regime, i.e. government? Would you change the players? Is there anything for the players around the table that is annoying, not productive, you wish people would do more, that would be better for the game? Or finally, would you change your own strategy and how you play all of it? And you're only allowed to do one. You can't do one. Which part of the poker table would you change?
No, I think one thing that over these years, I think that you come to realization, the only thing that you can like change or impact in a way is your exit decision making. I think that's one thing that is, regardless of what is happening with the market, regulation, the house, the players, anything. I think thinking about exit and being disciplined upon the exit consideration, I think is super important, because you cannot time the exit. Yeah. You don't know, like, things do change. But I think having a disciplined approach and having a procedural approach to exiting, that's where I think we as Flashpoint need to really continue working hard. I think we've been quite good with exits. We've done like 25 exits out of like 60 companies in the past, decade. So for us, we definitely come with an exit mentality and, turning capital, making money to our investors. But if I exited everything, and that goes to like all of the players around the table, if everybody sold in 2021, all of their portfolios, a lot of people would, but it's not possible, right? Because not everybody can sell, somebody needs to buy. So I think in that sense, that's definitely one thing that we need to keep evolving.
Is there any unfair advantage at the table, like at the poker table, in terms of the use? Well, on the exits, on the positioning, on certain country regulation, and I know you guys function in multiple jurisdictions, but there's certain rules that obviously folks would love to get.
I think that the table is divided into players who are more decisive and the players who are more passive. A lot of investors who we see, most of them are super passive, right? Early investors, even late investors, growth investors, even some private equity investors who are like thinking that they're active. a lot of people are, because exit is a very unnatural process. It's very natural to give somebody money, but it's very unnatural to take it away. It's very complicated and difficult. It's like giving a birth to a child in a way, right? So founders hate exits, for example, right? They'd rather keep like pushing, growing. They're optimists. They want to be unicorn. They want to keep going, right? So when an investor wants to exit, this is unnatural, right? Why do you want to exit? Everything is great. Why do you sell? Like keep going, right? But we need to in a way, and that's one of the problems in the industry. That's why we see a lot of evergreen funds being like, popping up right now, because then, in a way you don't you can keep the asset forever, right? There are, like Sequoia or some other guys who take it from seed to and they stay public, and, most of the portfolio actually is public stock right now, right? So where we are evolving, and everybody has their own stage in development. For us, I think this exit thinking is become very crucial from our size and point of development perspective, because I think you can either leave a lot of money on the table if you exit too early, or if you don't read signs, and there are many signs when you need to exit, you don't exit, then you can lose a lot. So for us, that's definitely one of the things that we need to keep working on.
And it's a hard cultural conversation with founders. Is that what it usually comes down to?
I think it's. I think for us, exit process basically comes through, first of all, alignment of interest, and because it's easier to sell 100%, obviously, if the founder is aligned and everybody wants to exit. But a lot of times, in 80% of situations, people either don't believe you can sell, just because somehow they don't believe it, right? And we've had a number of exits where we would just go out ourselves selling, and then others would join in once we get the bid, for example. And to a lot of people, and nobody says thank you, etc. But for a lot of people, it's counterintuitive that you can actually create an exit process through competition and drive the price to the level where they want to get to exit actually. So I think, for us as an investor, it's a matter of discipline. It's working out in a gym. You need to go and lift these weights, not because you want to, or it's just a routine. So for us, exit is a part of a routine. Not a lot of investors see it as part of their process, because we talked a lot about investing, allocating, but we always forget about the exit. And the exit is equally as important as the entry.
It's interesting because we don't forget about the exit as lawyers, partly because that's obviously a good result for our clients and a good result for us typically. But more importantly is that's when the legal framework, the documentation gets tested. Because if you've made mistakes, the exit is when it comes out, and so we're always exit focused. What do you want to do? Where do you want to do it? How do you want to do it? Because if you want to exit with a different mechanism, a different thing in a different jurisdiction, the tax, the structuring, it's just all different. So we try to get ahead of the 8 ball, and particularly in light of how global the world is right now. And I know we've talked a lot about US exceptionalism and this market being great. It's great for everybody. It's great for a lot of international capital, a lot of, as you know, founders and companies from all over the world who are setting up here. It creates all sorts of tax and other structuring dynamics that are very important to keep in mind as companies scale and move in. So, well, Sasha, I think we're a little bit running into our time. It's been an absolutely great opportunity with you. I'm excited to see what Flashpoint is going to do in New York, London, in Israel, and throughout the world where you're at in Eastern Europe. And I'm very fortunate not only to have been drinking with you 25 years ago, and I've gotten to know you over the years of working with you. Latham is grateful to have Flashpoint as a client and to work with many of your portfolio companies.
Thanks
so I appreciate that.
Kind words and our conversation.
Absolutely.
Thanks, man.
Thank you. Appreciate you. Thank you.